Hello, everyone. Welcome back to Wall Street Silver. Our guest today is Peter Boockvar. He is with the Bleakley Advisory Group. He is the Chief Investment Officer, and we're glad to have you back, sir.
Thanks for having me. I appreciate it.
Yeah, absolutely. You said in an interview about a month ago that the biggest risk to markets is not Putin, it's actually Jay Powell. So now the Fed, they want to reduce the balance sheet by $95 billion a month starting May. What's your views on this?
Well, I like to separate out rate hikes and what they do with the balance sheet. Rate hikes is meant to influence the demand side of the economy. It's supposed to, when they lower rates, try to encourage you to borrow money to spend on things, particularly interest rate sensitive parts of the economy like housing and autos. Whereas QE on paper was meant to, okay, if we buy long end bonds, we're going to lower interest rates. And that'll be sort of another way of cutting short-term interest rates. In theory, in practice, that really didn't happen because rates went up when they did QE and rates went down when they stopped or shrunk their balance sheet. This time around, we'll have to see where the yield curve goes, but also a major intended consequence of QE was to ease financial conditions and, in other words, boost stock prices. And Ben Bernanke, when he wrote an editorial in the Washington Post in November 2010, specifically said, this will raise stock prices, which will in turn encourage consumer spending and so on and so on, the whole wealth effect thing. So if that was the case of QE goosing asset prices, well, QT is now going to be a wet blanket on asset prices. At the same time, rate increases across the yield curve are going to slow economic growth. So it's a double form of tightening, similar to what we saw in 2018 in form, but much greater this time in size, both in the rate of interest rate increases and the pace at which they want to shrink their balance sheet.
You know, Fed Vice Chair, or soon to be, I don't know if it's officially yet, is she Vice Chair already? Brainerd said, she described it as rapid. Here, let me get this on the screen for you. Fed's Brainerd sees balance sheet reduction soon and at a rapid pace. And when Yellen did this back before, when Yellen was Fed Chair, she described it as watching paint dry. I mean, famous last words, and then it totally failed, even at trying to reduce it. Well, you have it on, you probably know how fast it was that time. What's the difference between 2018 and this time? What does rapid mean?
So QT then technically started in October 2017 at 10 billion a month. It was 6 billion of US Treasuries, 4 billion of mortgage-backed securities, and then every 3 months, it would roll up by 10 billion. And it ended up peaking at 50 billion 12 months later in October 2018 at 50 billion with 30 billion of treasuries, 20 billion of MBS. This time around, they want to get from basically 0 to 95 in 3 months, with the breakdown being 60, looks like it'll be 65 billion treasuries, 30 billion MBS. Now, that is what they want to do. Mm-hmm. It's easier said than done, though. It's very easy.
Exactly.
It's very easy on the treasury side. So the Fed has about 1.07 trillion of treasuries that mature that mature in under 1 year or up to 1 year, with about 300 billion of that up to, I think it's 90 days, and then 90 days to a year being about 700-ish billion. So that's easy to unwind because that just will roll off naturally. The problem is on the MBS side, because we've seen this sharp rise in interest rates, and we're essentially seeing a collapse in mortgage prepayments, the Fed is going to be forced to be outright selling mortgage-backed securities in order to shrink that piece of their balance sheet and get to that level of QT that they want with respect to agency MBS. So, which also means that you can be sure that there are probably going to be a lot of mark-to-market and actual outright losses that they're going to have to acknowledge when they do that. Now, they'll probably use accounting machinations to talk that away, but the Fed will likely be losing money as they sell off their mortgage-backed security portfolio, because I don't think it will be able to naturally run off in the time frame that they want it to, because the duration now is much longer because of the lack of prepayments because of the rise in interest rates.
If, 30-year mortgage rates just hit 5% the other day, I haven't checked today, but I assume it's going higher. Is the housing market really, people haven't seen these rates in a long time. And we already have pretty inflated values with everything going on in the world. I just got to wonder if the, like in 2018, they gave up. What was it? Why did they give up in 2018? When the bond market was just freaking out? What caused them to fail in running off their balance sheet? Give us a history lesson if you could. What caused them to fail and just flip back in 2018?
Well, we know what happened in the fourth quarter of 2018. The Fed got the Fed funds rate to 2.25, 2.5. The balance sheet had reached its max runoff, and the S&P 500 fell 20% in a rather short period of time. And we know that spooked Powell, on top of the manufacturing slowdown that was taking place in response to the tariffs. That a combination of those two things created the Powell pivot. And all of a sudden he backed off from those rate increases and was soon cutting interest rates thereafter. So that was what spooked him, which ironically is the path he's leading down again. But this time around, inflation is running at 8% instead of 1.5, 2. So his dilemma is obviously that much greater. And then, of course, in 2019, in the back half of 2019, he started to increase the balance sheet again. It was another form of QE because they got spooked that overnight rates started to spike in between interbank lending because they felt maybe that reserves in the system got too low and they needed to ramp up the reserves. Now, that had a lot to do with regulatory constraints on banks, but that's your typical government response, is that if there's an unintended consequence of what you're doing, rather than reevaluate what you're doing, just create a new policy to deal with those unintended consequences. And that was definitely the case then.
Do you think they're going to be successful, any more success this time compared to 2017, 2018? I mean, we already see these signs of slowdowns in the economy. I saw mortgage refinancings have dropped 60-something% already at just 5% for the 30-year fixed. You're already seeing the signs of a slowdown in a lot of different areas out there. I just question how far they're going to be able to even get in this before we have a Powell Brainerd pivot version 2.0, right?
Yeah.
Well, a soft landing is a rare occasion. We did see it in 95 following the rate hikes in 1994. They did raise interest rates a bit in 1984, and that did not disrupt the economy there. But the difference is there was a recession in 81. We started to grow in 82. So in 84, you're still early on in the recovery. That was easy to work through some rate hikes. In 94, there was a recession in 91. You were only a few years out of that recession. So you were able to work through what was a rather sharp increase in interest rates in 94, which did blow up Orange County and did blow up Mexico and did cause some reverberations, but didn't really hurt the recovery. But outside of those two instances, and then maybe back in the mid 60s, typically rate hikes like this are going to slow growth and lead us into a recession. Yeah. And considering how extreme inflation is, how extreme the response to that is now by the Fed and other central banks, because this is global synchronized monetary tightening. It's not just a Fed thing, as we know, that there's going to be a rather sharp economic impact and also market impact that's going to lead to major trouble. And how the Fed then pivots once they get into that mess will be very interesting to see. A lot of that, of course, will have to do with where the inflation rate is at the time. And it gets to the question, will the Fed focus more on the growth side and back off when they get to that level of discomfort? Or are they going to say, well, inflation's still high, we got to keep on going, even if growth slows? And Bill Dudley writes a piece for Bloomberg yesterday and says, well, we need to, crush the markets and the economy to get inflation down. Well, he can say that from the bleacher seats now that he's not playing on the field anymore. But when you're playing on the field, it'll be, a different calculus.
It'll be interesting whether or not the political pressure shifts away from inflation's no longer the top issue. Now it's, oh my God, I'd rather have a job at least, rather than, at some point it's like you got to have a job, and if that becomes the issue where the economy's dying, whether they go back to easy money and just ignore inflation. And I guess that's what we as gold and silver, the silver crowd, are thinking. All right, when the Fed pivot happens, is that the moment for gold and silver to launch? Because, all right, the Fed, as we've all been saying for months, the Fed is trapped. They have no good options. They almost have to go back to easy money at that point, and then they can't raise, right?
It will definitely be the magic moment, but in a way, gold trading at 1935 is having an important moment right now, even before we get to that point, because we've seen such an incredibly sharp rise in interest rates in a very short period of time. The 2-year yield going into this year was about 75 basis points. Mm-hmm. Today, we're almost 250 in 3 months and 6 days or 7 days. Yeah. So that gold is trading not far from a record high, not that much below 2000. In the face of this, gold's already showing its presence here. But that next major leg is when the Fed gets spooked, when they really slow growth and they back off while inflation still remains elevated. Now, inflation rates should start to come down as growth slows. We're already beginning to see the behavioral change in terms of the consumer in what they buy. They spent a lot of money over the last couple of years buying a lot of goods, whether it was a car or a deck in their backyard, or they redid a bathroom in their house, or they bought a Peloton or exercise machines or other exercise machines because they weren't going out and they weren't traveling and so on and so on. Well, now that they've already bought all that stuff, they're not going to repeat that sort of buying. And even if some wanted to or didn't do it yet, the prices have gone up so much that they're backing off. And we're already seeing that in the confidence numbers, where buying intentions for a home and a car are severely getting impacted by sticker shock. So back to the point, yes, we are setting ourselves up when the Fed eventually goes too far and backs off for a major leg higher. But to my original point, they're already really trading well in the face of a very sharp. When you think about the sell-off in gold and silver in 2021, which going into the year was really the ideal setup because we got the inflation that a lot of us thought we would see. But people thought, well, it was either going to be transitory, or if it was not, well, the Fed would come to the rescue and rates would go up, and why would you own gold and silver? Well, it was not transitory, and rates are going up, and all you want to buy is gold and silver. So it was basically bad reason to be selling it in 2021. And I think that that's now being reflected this year, considering how well it's trading.
Hey, I wanted to ask you, the other hot topic is food. With everything going on in Russia and Ukraine, they're both being massive producers of corn, wheat. A lot of agricultural commodities are just going through the roof lately. What's your thoughts on this? Is this something you worry about? Is this this is a global issue. There's a lot of countries that get by on 1,200 calories a day or less, and losing a ton of wheat out of the market. That's going to push a lot of countries over the edge, don't you think?
No doubt. And we're already beginning to see protests of people frustrated with higher prices. And unfortunately, it is only going to get worse. And you look at unfortunately, the dearth of grains we're going to be able to get out of Ukraine this year, with the planting season pretty much finishing up, but probably a fraction of the acres that they pre-war were hoping to plant. Now, the harvest won't be until September, October, so the pain won't be felt until then, but it's coming. Now, one positive is that you have countries like India and Brazil and Argentina, even the US, that is going to be sharply ramping up their production, or at least hopefully their yields, to mitigate some of that lost grain production out of Ukraine, and even Russia, who's going to be limited to the extent of not being able to ship enough and possibly not get their hands on enough fertilizer, even though they do produce internally. At least Belarus does, and they can ship as much fertilizer as they can to Russia. But I think overall, there's going to be still upward pressure, unfortunately. And as to your point about those that will be less or least able to afford it, it's going to be difficult. So there's no question it's a worry. And I don't see any resolution anytime soon. We can only hope that other countries, as I said, can mitigate it by really ramping up. And I know I read an article the other day about India is really doing their part to ramp up and the production of wheat, and even creating their own new agreements with Egypt, for example, that imports, I think, about 85% of their wheat needs.
Yeah, it's a huge issue. And Russia, everyone's spoken about the wheat issues coming out of Ukraine, but Russia's a huge exporter of fertilizer, and also
which they've now limited. They've ended those exports for now. We'll keep it internally. So that the lack of fertilizer. Now, with fertilizer is very intensive with corn. You can use less of it with soybeans, and farmers could forego a planting season.
I saw that article.
Right, but then the following year, there'll be some payback, and maybe the yield won't be as good. But I think generally speaking, the lack of enough fertilizer will keep crop prices elevated for a longer period of time. I mean, we're used to seeing, commodity prices go up, they come back down again as supply demand recalibrate. I think this time around, they're going to go up, and they may stay up for a longer period of time than people are used to.
Well, Peter, I want to thank you for coming on and sharing your thoughts. I really appreciate it. You're a huge superstar on CNBC as a regular guest there. And thanks for coming on our little channel and talking with our audience. We appreciate it.
I always appreciate the invite, and always good to chat the world with you guys.